Joe Anderson, CFP, and Big Al Clopine, CPA. Hello and welcome. How are you guys doing?
Fantastic. How about yourself?
Very well. Good to see you.
Same. Yeah, doing all right. Alan, you're in Hawaii and social distancing at its best.
Yeah, I was trying to get more than 6 feet away. I think I succeeded.
You certainly did.
Yeah.
You certainly did. So, hey, welcome everyone. Alan and I used to do these tax workshops or seminars, a couple times a year, and we would do them at the Sheraton? Isn't that where we used to do them at, or the Hilton? Anyway, we would get several hundred people there to kind of right at this time to look at last-minute tax ideas. This year's a little bit unique because there's an election, but there's different tax laws that we want to make sure that you're aware of. So what we have a deck for you that will probably take us 30 minutes, but ideally why we put these on is to help you and answer any questions that you might have. I know that you're meeting with your advisors on an ongoing basis or with the whole Zoom. Hopefully we'll get you all back into the office here shortly. We'll see when that is. When this whole thing came about, it was like, all right, well, hopefully clients can come back in a couple of months. Can you believe it's right? First week of October already. So we've been living in this crazy new normal now for quite some time. So hopefully all of you are safe and sound and staying active and healthy as much as you can during this world we live in. So, Alan, do you got any beginning thoughts before we kind of kick this thing off?
I certainly do. I think taxes, one thing we know about taxes is they change. Taxes change all the time. We've had a couple new tax law changes recently within the last year that we'll certainly go over today. And then it's like with the election, what else is going to happen, right? So we'll kind of get into that a little bit.
Cool. And Andy's going to be holding on to the chat function, so fire away. So if you guys have questions, this is what makes this fun. This is why we really enjoy doing this, because we'd much rather answer questions off the cuff than kind of reading a canned presentation. So as we go through them, hopefully it sparks some questions for you and use this as that resource. So let's get this thing fired up, if you will. So basically, we're looking at. All right, yeah, get the heck out of here, Al. Most of you know us, right? I'm Joe Anderson, Certified Financial Planner, President here at Pure, and Big Al, him and I have been working together for many, many years. And he's got the grandiose title of CEO, so he stands above me. So,
and don't you forget that.
I won't, sir. I will not. You're lucky you're in Hawaii.
Yeah, it's been fantastic. Aloha to all of our webinar viewers.
So why is the timing could be right for more tax changes? We've seen tax legislation, a couple of huge bills that just passed over the last couple of years than we have in the previous 30. And so why do we think it's fairly right? And I'm sure you've all seen this before, but we're living in almost all-time low tax environment. So if you look here, when Alan started his career in 1945 as a CPA, the top marginal bracket was 94%. Reagan got into office, he brought it down to 70%. So it's 70% for 30 years? It went down to 50%, and then now we're at 37. So when you look at tax rates, we feel that they can only probably go up. Hopefully they stay low. Hopefully they stay low for quite some time. But I don't know. We could do a poll, I guess, Andy. Maybe we do that. Let's ask our clients where they think taxes are going to go. If they think they're going to go up, are they going to go down? Are they going to stay the same? Because depending on your belief system here in regards to taxes, we can talk about different strategies of what's going to make the most sense given where you think tax rates are going to go. Because I don't have a crystal ball. I have no idea where they're going to go. I believe potentially they're going to go up. I'm not sure how high because they're already slated by law to go up. But I'm curious. Let's do a quick poll.
So that poll is on screen now. Will taxes go up, go down, stay the same, or you don't know? And there's a little bit of a delay between when we say it and when you see it. So I'm going to give you 5, 4, 3, 2, 1, and give it a couple extra seconds. And then I'm going to close up this poll. Right now, 95% believe that taxes are going to go up. Only 4% say that they don't know.
Okay. So no one thinks they're going to go down?
That is correct.
Not one person.
Not one person. Apparently, you've trained them well.
Well, I don't know. Al thinks they're probably going to go down.
Oh, wow.
I don't know if he voted.
Well, I don't know. I mean, if you look at this, so just to put a little sanity in here, I actually did start my career in 1980. So it actually was 70%. And it was actually Reagan inherited that and brought it down to 50, which I remember, Joe, at the time thinking, wow, can we do that? 50% seems really low. And now we've been used to 35 to 37 to 39 for quite some time. It's like, historically, it sure seems like tax rates are a lot lower than they have been, and we got this big deficit, so there's a lot of pressure to raise it later.
When you look at why we're doing this, I think it's the biggest thing that we want you to do. We're going to see some volatile times. I think, some of us have lived through more elections than others, but every time there's an election, we'll see a little bit of volatility in the overall stock market. October's usually a fairly high volatile month historically. So we want to control what we can control. Unfortunately, we don't have a crystal ball to tell you exactly where the markets are going to go when they go. But we can control our discipline and the overall strategy. We can control our fees and risk of what the overall portfolio looks like. But I think more importantly, last but not least, is the taxes that you pay on the distributions. If you're creating income from the portfolio right now, is there strategies that you can implement or understand that you can reduce the overall taxes so you can control the bottom line, to your overall personal net worth? So the agenda real quick, there's just a few items in the CARES Act that I want to share with you. We'll go into the Secure Act. So these are the two acts that were signed within the last 10 months, 11 months. And then there could be this tax time bomb waiting. And then we'll look at some tax planning tips. So any questions that you have along the way, Andi will probably interrupt us if it's applicable to the topic. So when you look at the CARES Act, so this was the stimulus act that was signed back in April, I believe, or March. And President Trump just recently, yesterday, said, okay, there was going to be a CARES Act 2.0. The markets kind of was waiting for it. Yesterday, he said, no, we're not going to look at any more stimulus until after the election. So the CARES Act was a stimulus program that put trillions of dollars in the overall economy, and it had to do with unemployment benefits. It had to do with a little bit of a kicker for unemployment benefits, and it changed some of the distribution laws in regards to retirement accounts. So a CRD, coronavirus-related distribution. So what the heck is this? This allows an individual or a family to take up to $100,000 out of a retirement account. So $100,000 out of a retirement account, and they can avoid the 10% penalty if you're under 59.5. It can avoid the 20% mandatory withholding if you take it out of a 401k plan. So you can pull that $100,000 out, and you can either pay that $100,000 back to any qualified retirement plan over a 3-year time period, or pay the tax over a 3-year time period. So it's a big deal for a lot of you that have a lot of money in a retirement account. We're always trying to diversify from a tax perspective, because if most of my money is sitting in, let's say, my IRA or 401k, every dollar coming out of there is going to be taxed at ordinary income rates. And if we believe that tax rates are going to go up, okay, so that means more taxes potentially on the distribution that comes out to us in a form of income. So the CRD allows people to take dollars from a retirement account tax favored. So you have to qualify. The qualifications are, well, you need to be diagnosed with COVID, or a spouse, significant other. Maybe you got furloughed. Maybe you had reduced hours. So there's some broad brush here of what they looked at, what qualifies. The interesting thing with this is that the last bullet point was like, well, anything else that we deem okay, right? Because they realize that a lot of people are affected by this pandemic, in that where do people go that have liquid assets? Most of their liquid assets are in a retirement account. So let's say if they didn't come up with this and someone got laid off or needed to pay their mortgage or just needed some cash. So they go to their retirement account and they pull $100,000 out of their retirement account. Well, you would have a 10% penalty if you're under 59.5, plus ordinary income tax up to 37%, plus lovely state of California is going to take their 10 or 13%, right? So that individual potentially could lose 50% just unnecessary taxes. So they would have that tax bill next year, and then wait a minute, where are they going to come up with that other $50,000 potentially of tax that they need to pay next year from the distribution that they took this year? Where would they come? Where would they come up with the cash? Well, they would probably have to pull it out of their retirement account again, and it's just a snowball effect. So their retirement accounts could get blown up. So they came up with this to allow people to take money from a retirement account. So if you're affected in any way by the coronavirus, this might be a strategy to start taking dollars from a retirement account tax favored. You can pay that tax over 3 years. Let's say if you wanted to put it into a brokerage account. Alan, you got any other comments on this?
Yeah, Joe. Also, at any age, there's no 10% penalty. So you get the money out with no penalty. And if you're in a lower tax bracket this year and want to pay the tax this year, you can do that too. You can elect that. Otherwise, you pay it over 3 years. So it's actually really a pretty good deal. It's a good way to diversify, even if you don't exactly need the money right now.
And we do actually have 2 questions that are related to the CARES Act. First one is from Craig. He says, if you take $100K and repay $33.33K per year back into the retirement accounts over the next 3 years, does that mean no taxes paid?
Oh, yes. Well, so I guess if he's paying back the retirement, he's paying back the retirement account $33,000.33.
When he takes the he takes the 100,000 and then he pays it back 33 1/3 each year.
Yes. So yeah, you have 3 years to pay the account back. There's no taxes due. The technical aspect of it is this: is that let's say if I take $100,000 out and I pay it back over a 3-year time period, I will pay tax, but then I would amend the return to get the money back. So, Alan, do you want to explain that a lot better than I just did?
Yes. So the default is that you pay the tax over 3 years. But the thing is, if you want to pay the IRA back or the 401k, you've got 3 years to do it. So what you need to do, you still need to pay that 1/3 of the tax in year 1 and 1/3 of the tax in year 2. Like let's say the example of you pay it all back in year 3. Then in year 3 you pay it back. Then you have to file an amended return to get your money back from year 1 and 2. So that is possible. So in this example, if you pay 1/3 of it back this year, you're only going to have to pay taxes on 2/3 of it. So you pay 1/3 of that 2/3 this year, and so on. It gets a little tricky, but you can get your money back, but you may be out of pocket for a little while.
All right, and then the second question is actually from Mark, and it's about the $1,200 stimulus payment. He said, are there any tax repercussions for receiving that $1,200 per person CARES Act payment?
No, because it's a tax credit. So it's basically a tax credit on your 2020 tax return, but they just fronted us the cash this year. So when you do your taxes for 2020 and 2021, if you did not receive a check, a stimulus check already, because your income was too high, right? That you had too high of income that phased you out of the stimulus check, but this year you did qualify because you had lower income, because you were furloughed, because you were laid off or whatever, right? Then in 2020 tax return, you would actually receive a tax credit. So you would get the stimulus money, you would just get it in a form of a credit on your 2020 tax return. So the check that they fronted us, it's tax-free. It's a tax credit basically on a previous year's tax return. So no, you would not report that on your tax return or anything like that.
Yeah, tax-free for federal and state.
So they also eliminated required minimum distributions in 2020. So for those of you that are used to taking required minimum distributions, we're recommending that you might still want to take a look at it, but actually convert the RMD into a Roth. There's no other year that you could convert RMDs into a Roth IRA, but since they eliminated the RMD, since tax rates are low, since you're used to paying the tax anyway, you might want to consider just converting the required minimum distribution into a Roth IRA, and we'll get into Roth conversions here momentarily as well. So looking at the Secure Act, so this was signed in December. So when you're looking at the Secure Act in December was signed, and it was kind of a hidden bill. No one really knew what the heck it was. And it wasn't the best bill, to be honest with you. It was kind of a joke in my opinion, but I don't want to get political. The Secure Act is, strengthening every neighborhood to have a wonderful retirement or something like that. Basically, what it did is get rid of the stretch IRA to fund it all. For those of you that have large retirement accounts, if you were to pass away and if it went to a non-spouse beneficiary, you were able to stretch out that tax liability over the kid's life expectancy. So if I were to pass and it goes to a 4-year-old and that 4-year-old has 80 years of life expectancy, well then that 4-year-old would have to take 1/80th out of the account, which is a smidge. What happened with the Secure Act is that they want to accelerate the monies coming out of the retirement accounts. So we saw a glimpse of this a few years ago when the Supreme Court voted that, hey, inherited IRAs, they're not an asset, right? It's income. So it's not protected for bankruptcy and things like that. So the stretch IRA, you want to make sure that you look at strategies to preserve your wealth over, I guess your beneficiary's lifetime. So this is a big deal. This is going to cost a lot of people a lot of unnecessary taxes because they're forcing that money out fairly quickly. And it depends on how the beneficiary is named on your retirement accounts. It could get forced out in 5 years or 10 years. And we'll probably see this shrink even fewer years. So just be aware of that.
Yeah, Joe, this is a pretty big deal because you think about it, IRA balances, 401k balances, in some cases are getting pretty large. And if you don't necessarily need the money yourself, or if you pass away relatively early, then the kids get it and they had their lifetime to stretch it. Now they can't. They have to do it within 10 years. There are a few exceptions. You mentioned if you're a spouse. If you're a spouse, you can still stretch. That didn't change. If you're a person that's within 10 years of age of the person that passes away, let's say a sibling, for example, they can still stretch over their lifetime. If you're a minor child, you can still stretch, but only till the age that you reach majority, which in California is 18. Or if you're disabled or chronically ill, you can still stretch. But otherwise, for most people, that stretch IRA for the beneficiaries is gone.
For those of you that are naming a trust as the beneficiary of your retirement account, be very careful there. Let's say if you wanted to control the money from the grave, and you're like, all right, well, when I pass away, I want a certain distribution of my wealth to go to the kids or the grandkids or nieces or nephews. So I'm going to wait, I'm going to hold it in trust, and I'm going to have discretion on how those distributions happen, right? Be careful there. You want to make sure that you relook at your estate planning because trust tax rates are completely different than human tax rates, right? If I look at the ordinary income rates of a married couple, right, you're still in the lowest brackets at $80,000 of income. You know, trust tax rates, you're in the highest tax bracket, roughly at about $10,000 of income. So understanding trust tax rates versus beneficiary tax rates are two different things. So you want to make sure that you take a look at what is the beneficiary on your retirement account and if your goals are still aligned. So if you have a discretionary trust or a conduit trust, so there's different rules. So make sure that you have us, your advisor, one of your estate planning attorneys, relook at that because you might want to make some changes in regards to your estate plan. This is for Big Al, right? So no age limit for IRAs. Before you had to be under 70 and a half. Now they realize that people are working. They're going to continue to work until their 70s and 80s for some of us, or maybe even later. So they said, well, why are we eliminating, the ability for people to save for retirement? So they increased the overall age limit to whenever, right? There is no age limit to contribute. What you do need is earned income. So if you're still working and you make $7,000, you can still make that $7,000 contribution to a retirement account if you choose to.
Yeah, Joe, and this means the Backdoor Roth, which we'll get into in a second, is available now for people over RMD age, which was not the case before.
So no age limit. And then, there was some other things, Al, too, with MEPs and employer plans. So for 401k plans and so a lot of employers actually do not offer a 401k plan. So the Secure Act came up with a few different ways for small businesses to offer 401k plans at a lower cost. Because setting up a 401k plan for, let's say, our firm, we have roughly 75 employees, to administrate that's a cost for the employer. And so a lot of employers say, you know what, I don't want to burden that cost. So they came up with some alternatives for employers to group together to share the cost, to offer retirement accounts, just about, to everyone. So there's a few other positives there, but I mean, what they pushed out the RMDs to 72, and then they didn't have, and then there's no age limit to the IRAs. That's basically the gist of this. So nothing too exciting besides the elimination of the stretch.
Gordon is curious about inheritance taxes or death taxes.
Good question. That didn't change with either of these bills. So right now it's around $11.5 million goes to the next generation tax free, and if you're married, it's double that. So it's over $22 million. Could that change in the future? Yeah, absolutely. And in fact, we're supposed to in 2026 come back to the pre Jobs Act and Tax Cut and Jobs Act of 2018. Anyway, so these lower rates that we have right now are scheduled to come back, and the estate taxes are scheduled to come back as well. And if there's a change in party, who knows? Or even if we have the same party, who knows? Anything is subject to change, I would say.
Okay, required minimum distributions. So it's not 70.5 anymore, it's 72. So they pushed out the RMDs to age 72. So if you turn 70.5 this year, you do not have to take your required minimum distribution. So they pushed that out a couple of years. So number 3, it's kind of the tax time bomb that a lot of us might be facing. So this could be a little bit small, but let me explain to you how tax rates work. So this is single, this is married, this is head of household. So if you look at the tax rates today, and I think 95% of us all agree that these are going to go up, but the 10% tax bracket goes up to about $20,000 of taxable income. So the 12% is between 20 and 80,000, 22 is 80 to 170. Right? So these are pretty big numbers in regards to the brackets. The 24, it goes up to $326,000. So what's changing in 2025 is that the 10% bracket stays at 10, but 12 goes back to 15. 22 is going to go to 25, and 24 will go to 28. So between that 12 and 24% tax bracket, that's where most people fall. And it's reverting back to the Jobs Cut, the Jobs Act that Trump signed a few years ago, that it's already going to sunset. So when they passed the law, the corporate taxes were permanent. The individual taxes were basically due to sunset in 2025. So January 1st, 2026, it kind of reverts back to where they were before the tax law was signed. So we already know today, and of course, who knows what could change, but we know that these tax rates are going to change. So there's opportunity to pay taxes at these rates where you want to make sure that you're taking a look at to see what makes sense for you. So if you're married, here's your rates. If you're single, you just kind of cut them in half. And if you're head of household, you can see where those are. If I look at the capital gains rates, okay, so we have a 0% tax rate in capital gains. So that's up to $40,000 as a single taxpayer. Married, it's $80,000. So it's basically at the top of that 15% bracket. And then separately, it's 40 grand. But then we have this 15% tax rate that goes to about $500,000 if you're married, or $250,000 if you're separate. In single, it's $441,000. And so on. You guys can read this, but 20% is the largest tax rate in regards to cap gains. Okay. Then we also have the net investment income tax, which is another 3.8% if you have income over $200,000 for single, $250,000 for married. So understanding where you fall in regards to cap gains or ordinary income is really going to determine what type of tax planning that you want to take a look at for year end, because next year it could be a whole new ball game. Depending on, right? I don't care who gets elected. It's just that there's a lot of stimulus that kind of pumped into the overall economy. And really, there's 3 ways to to kind of get rid of the deficit or the debt is that we could grow ourselves out of it. So we find a vaccine, everyone's back to work, and we're booming, and we grow ourselves out of it. That would be fantastic. I don't know if that will happen. We can inflate our way out of it, right? So rapid inflation. I know the Fed's already saying that's not going to happen by keeping interest rates very, very low for quite some time, or they could tax their way out of it. So just understanding that, all right, we have a fairly large deficit in debt. Here's where tax rates are. They're the lowest that they've almost been in the history. Is there a way to capitalize on this? And how we look at things when it comes to an investment strategy is first we want to look at taxes, and we want to see where the taxes are. And I'm sure a lot of you have already seen this. And Andy, can you give me full screen, please? Good prep work here, Jake. Thank you for making sure we have markers that work. Right. So you got the three different pools of money. You got tax-free, you got taxable, and you got tax-deferred. So tax-free would be the Roth IRA, or it could be municipal bonds, right? So when you pull money out of this account, right, 0% taxes on the way out. So this is that cap gains rate that I just explained. So if you have a capital asset and you sell that capital asset, as long as you hold it for a year, you're going to be taxed at a cap gains rate of 15% for most of us. But then there's also the 0% rate if you're in the 10 or 15% bracket. If you're in a high bracket, it's going to cost you 20%. Then the net investment income tax, another 3.8% on top of that, depending on where your income is. So tax-free cap gains, but then the tax-deferred assets, these are our IRAs and 401ks, 403bs, TSBs, and the like. When you start taking money out of here, as some of you already are, you know that you're taxed at ordinary income, the highest of rates. So it's like, okay, well, I already know that I have to pay the piper here at some point. And if we can look at where ordinary income rates are, does it make sense to buy the tax cheap? And we believe it does. Okay, we've been preaching this for 15 years, is that it might make sense to start bleeding some dollars out of here. And so we talked about the coronavirus related distribution. So that's the ability to pull $100,000 out of this account and maybe move it into a brokerage account. So the future growth on that investment is going to be taxed at a lower rate potentially than ordinary income. And if you're in a lower rate today than you will be in the future, depending on where tax rates go, that might make sense to pay a little bit cheaper rate. Another thing is that we want to look at, does it make sense to utilize the tax rate to take money from here and to move it up into the Roth, right? You have to pay tax on that conversion, but guess what? All of those dollars will never, ever be taxed again. 100% tax-free for life. And there is no required distribution up here. So compounding, tax-free for your life, spouse's life, and the kid's life. It's a pretty good deal. So if you can get money up here with a tax-favored environment by doing that conversion, we believe that might make some sense. And that's why we want to continue to look at that each and every year. Will this year make more sense than others? It could, right? Just because we believe that tax rates are low. Andy, what's up?
Got two questions here. Let's see. From Ray. Ray says, if I believe taxes will be on the rise, should I focus more on accelerating Roth conversions or long-term capital gains harvesting in the near term? Basically, I'm curious if long-term capital gains or ordinary income tax rates have historically been more sensitive during rising tax periods. And then he's got a follow-on question as well.
Well, I'll answer what I believe, and then Al will probably have a better answer. But the capital gains rates have been lower than ordinary income rates almost since, I think, the history of the tax code, because the idea behind a capital gain rate was to encourage investment. So if I'm investing, right, and if I'm taking on risk with my capital, then I'm going to receive a favored tax treatment for that risk. So if I lose money in a capital asset, so if I lose money in a stock and I sell it, right, that loss is a capital loss that I can write off on my tax return. On the flip side, if I have a gain and I sell it I'm getting taxed at a lower rate because the IRS or the Treasury, whoever, wanted to favor risk taking. So they gave us this benefit here. So will capital gains go up? Well, it's talked about. One candidate is talking about capital gains, depending on what income level that you are, could revert to ordinary income. That would be pretty hard to do. That doesn't really encourage investment, but that's some of the things that could happen. Al, have you ever seen capital gains rates the same as ordinary income? Long-term capital gains rates, or have you ever seen cap gain rates higher than ordinary?
Yes. Under President Bush, #1, father, for a short period of time, capital gain rates were the same as ordinary rates. They were both at 28%. So that did happen. It didn't last very long, and the reason it didn't last very long was the reason you alluded to. Is we're trying to encourage investment in companies and real estate, and that creates jobs. So it seems likely to me that that's not really going to happen, or if it does happen, it won't happen that long. So I think capital gain rates are probably here to stay. You never know for sure, but the original question on should you favor capital gains or Roth conversions, and the answer, like in most cases, it depends, right? If you've got, let's say, a lot of assets outside your retirement account with gains, and you need to diversify, you might want to focus on that, because taxes are one thing, but you need to be invested properly. On the other hand, if your investments are already pretty good and you don't really need to make many changes, then maybe you focus on the Roth conversion. Generally, you don't do both in the same year, although there are some exceptions. It's just the way the tax rates work.
Right. I think you want to look at what percentage of your assets that you have in each of these different pools, right? If 100% of, 80% of my assets here and 20% are here, does it make sense to take advantage of the capital gains versus conversion? Maybe not, because you're not very diversified. On the flip side here, if you're in the, a low bracket and you have high gains here, where you could take advantage of that 0% cap gains rate, well then, yeah, you might want to do that. So, like Al says, unfortunately, it kind of depends on your overall situation. So it's looking at it like this too, is you want to kind of fill your buckets up. So maybe you're at the 10%, 12%, or 22%, and it's like, well, I have room in this 22%. Maybe I do a conversion to the top of the 22 because I believe I'm going to be in the 25% in the future. Well, or you might fill up the 24. So we look at kind of this bucketing approach in regards to conversions. It's a lot more sophisticated than that, but I think most people get this. It's like, well, first utilize your bracket, but ideally what you're trying to do is to have enough diversification in each of these different pools, so when you start taking distributions from it for income, you can control your tax liability. But with that being said, you want to look at a few things when it doesn't make sense to convert. In L, we just talked about the 0% capital gains rate. Sometimes if someone wants to diversify out and take advantage of diversifying here and looking at that 0 capital gains rate, that might be a better option.
It could be, because that 0 capital gains rate, as you said, for a single taxpayer goes up to about $40,000. Taxable income for married about $80,000. So let's say you're married and you have taxable income of $50,000, just for an example. That means you got $30,000 of room in that bracket. You could sell stocks, mutual funds, whatever, $30,000 worth of gain and pay 0 tax. So that's what we call tax gain harvesting. It's a way to diversify, get out of a position, and pay no tax. Now, you may pay state tax. California doesn't recognize that rule, so at least in California, you pay the state tax, but no federal tax. On the other hand, as I mentioned, Joe, if you do that, and then you also do a Roth conversion, well, now you're of $30,000. Now your taxable income is $110,000, and you're paying the 12% rate on the conversion. But then you pushed your capital gains rate to where they're taxable. You're paying 15% on them. So that's why in many cases you don't want to do both in the same year. It's just the interrelationship between the two.
Yeah, can you talk about that a little bit more, because we get this question quite often. And let me go back to let's say the actual tax rates. So we know capital gains rate. So let's say if you're married, up to $80,000 of taxable income, there is no capital gains rate. But if you look here, right, up to $80,000, you're in that 12% ordinary income tax bracket. So what happens is that they count ordinary income first, and your capital gains sits on top. So some people get really confused. It's like, well, what does that mean if they sit on top? Let's say if I sell a piece of property, and let's say I have a $200,000 gain, but my taxable income is already $200,000. So am I in the 24% tax bracket? Because that would be $400,000 of taxable income. So how does this all work? And then that's why looking at conversion sometime, because that's ordinary income, and then your cap gain sits on top, is going to be, all right, well, what rate will those capital gains be? It's not going to be ordinary income, but you could push yourself up from the 15% to the 20%. You could push yourself from just this flat 15% now to the net investment income tax on top of that at another, close to 4%. So just understanding kind of how the tax system works means a lot. And then Andy just shrunk the hell out of us here.
Yeah, and let me just do a quick example, which is, let's say you make $325,000. You're very successful. Let's say you're married and you got about a $25,000 standard deduction. So your taxable income's $300,000. So as you can see, you're in the 24% bracket. Married, $300,000 taxable income. Now let's say you've got that $200,000 capital gain. So the capital gain does not push you into the 32% bracket. The ordinary income tax is calculated first. But then, Joe, go to the next slide, if you will. Because with a $200,000 capital gain, now your taxable income is $500,000, right? So some of your capital gains are taxed at 15%, and some are taxed at 20%. Now, in this example, it's only $496,000. It's only $4,000 tax. But let's say you got a $1 million gain, right? So at any rate, most of that gain will be taxed at 20%. So that's what we mean about capital gains sitting on top of ordinary. You compute your ordinary income tax rate first, then you add your capital gains to that to see what capital gains rate you pay. Realize that the higher your adjusted gross income or taxable income, you're phasing out all kinds of things, like you're paying more net investment income tax. Maybe you're not getting to deduct as much of your rental property losses. Maybe you lose your QBI, qualified business income deduction. So there's all kinds of detriments of having higher income, but that's how it's calculated. Ordinary income first, capital gains second.
Let's talk about QBI real quick. This came about in the Jobs Act. And so if you're a small business owner, you have real estate, some of you will qualify for this QBI deduction. But again, if you're doing conversions that are increasing your overall taxable income, that could phase you out of this deduction. So running tax projections and making sure that you kind of get everything here. And of course, that's what we do for you. But just FYI, if someone else watches this webinar that's not a client. IRMMA is another thing that some of you are very concerned with. But you have to look at IRMMA, and what IRMMA is that it's Medicare premiums are basically means tested. The higher the income that you have, the higher Medicare premium that you're going to have to pay. But it's kind of a weird thing. So let's say if you have a large income this year and you're not paying Medicare, or you are paying Medicare, you're 65, you're paying your Medicare premiums, and you have a very high income this year, you do a big conversion or something like that, you're not going to see a Medicare tax per se, right, on your tax return. What happens is that in 2022, your Medicare premiums increase because there's a 2-year look back, taking a look at your overall income to determine where you fall on the scale for Medicare premiums. So how we look at computing this is that if we all agree that tax rates are going to go up, and they're going to go up significantly, in my opinion, is that if I have to pay another couple $1,000s per year on my Medicare premiums, just put that in as a tax and then look at your effective rate. In most cases, it's still going to be a lot lower than what bracket potentially you're going to be in. but it's still something that you want to look at. So if you do a conversion or you're gung-ho on conversions, but you don't want to pay another $100 to your Medicare premiums, then you might want to relook at it. But guess what? You're just going to end up paying, in my opinion, thousands of dollars more, potentially in unnecessary taxes as the rates potentially climb. And then one last thing is that a lot of you don't understand pro-rata. And what pro-rata means is that if you have a basis inside your retirement account, so there was a non-deductible contribution at some period, so or maybe you open up a separate retirement account and you do a non-deductible IRA. Well, if there's basis in an IRA, you're not going to be double taxed on that. So that basis is going to come out to you tax-free. So you open up a separate IRA, you contribute $6,000, $7,000 into that IRA, and then you're like, okay, well, I'm going to take this and I'm going to take this money out and not pay any tax on it. Or I'm going to take this money and convert it into a Roth IRA and not pay any tax on it. Unfortunately, it doesn't work that way. There's pro-rata rules. So they take a look at the aggregate of all your IRAs, SEP IRAs, simple IRAs, and regular IRAs, individual retirement accounts, and they look at the balance of that account, and then they add in your basis. So then they do a division of what your basis is compared to the overall balance of your retirement account, and then that's going to determine your tax-free component. So some of the strategies that we talk about is called a backdoor Roth IRA contribution or conversion. This is creating basis in a retirement account and then converting it. If you have other IRAs, it's very difficult to do this strategy. So you want to isolate your basis. So there's some strategies that you can do there as well, such as rolling money into a 401k plan, because 401k plans don't take after-tax money. So that could isolate that basis and you can convert it. You can roll some of it into, I don't know, like a HSA plan. So there's different things that you can potentially do to isolate the basis. So Al, any additional comments here?
Yeah, by the way, that pro-rata rule, which is confusing in and of itself, and further confusion is what it counts, right? So it counts your IRA and your SEP IRA and your simple IRA, but it does not count your company retirement plan like a 401k or 403b or TSP. So just be aware that it's just IRAs for this computation.
Tax loss harvesting. So our investment team is very active in regards to harvesting losses within your overall accounts. And so what that means is that as we're going to see more volatility in the overall stock market, right? The market's kind of do this. And so, okay, I purchased it here, but now it's worth here. I bought it at $10, now it's worth $5, hypothetically, right? So we have this $5 loss. So we would sell that security or that mutual fund or exchange traded fund, and we would buy something similar to create that loss on your tax return. And then as the market goes back up or goes back down, we're looking at these troughs. Instead of selling and going to cash, which you definitely don't want to do, we're buying a shadow position, which is very similar to the position that you currently have. Why are we doing this? Why do we want a tax loss harvest? Because as I said earlier, when you have dollars in this account, these are subject to capital gains rates, 15%, 20%, or zero. But the loss on any investment that you have offsets that gain dollar for dollar. So if I had a $5 loss and a $5 gain in something else, and I needed $5 for income, so I'm going to take $5 out, I can net that loss against the gain and zero my tax out. I can zero the tax out. So when we're looking at strategy in regards to taxes, tax loss harvesting, for those of you that have a lot of money in a non-retirement accounts, as this gets volatile, we're trying to harvest as many losses as possible to offset any future gains. So when you do create income or there's dividends and distributions from that account, those losses offset those gains. So it's a big deal. All right, so next is that we talked about this, tax gain harvesting. So that's losses, but if you have gains and you're in that 0% capital gains rate, right, that's going to be tax-free to you as well. So we're always trying to look at the net after-tax return on the portfolio. Take at least amount of risk possible, take risk where it's needed, but then try to create that tax alpha, okay? So that when you are creating income or the after-tax return is its highest. Okay, so tax gain harvesting, we're looking at doing that, of course. Backdoor Roth IRA we've talked about. So for those of you that don't qualify for a regular Roth IRA contribution, so $7,000 that you can contribute if you're over 50. The brackets, the phase outs is about $200,000 for you married folks and $130,000 for single. If you make too much, and this is modified adjusted gross income, if you make too much dollars, then you are disqualified. Okay. However, there is no income limitation to do a straight conversion. So if you make $1 million, you can convert money into a Roth IRA. So a backdoor Roth is doing that after-tax contribution and then converting it directly into the Roth IRA. Net unrealized appreciation, for those of you that have company stock in your 401k plans that have not yet retired, just understand that you can take that company stock out of the retirement account tax efficiently, okay? You can pull it out of the account, you pay tax on the basis, but all that appreciation, again, is taxed over here at capital gains rates. So huge benefits there for those of you that work for companies that have a lot of company stock inside your employer-sponsored plan. And then Al, for people that are charitably inclined, you know, 'tis the season, it's almost the holidays, right? So, you know, the donor advised funds are very popular with a lot of you, but if you want to just briefly talk about this, and then we'll open it up for questions.
Yeah, Joe, this is a great way to go when you want a large contribution deduction, but you don't necessarily know who you want to give to, or maybe you want to get the deduction now because you're in a high bracket, and then dole it out later over time. So what essentially that you do as the donor, you give either cash, stocks, or you could do real estate, for example, but most commonly people donate appreciated stocks into this donor advised fund. Whatever they're worth at the date of the donation is the deduction you get on your tax return. $100,000 stock donation is a $100,000 deduction on your tax return right now, right this year when you do it. Now then the gifts go to charity, but you get to advise who they go to over time. So again, it's you take the deduction now. And another way to think of it is you're taking future years' contributions and deducting them in the current year, getting the benefit right now when you need it. For many of you, you're now using the standard deduction because it's so much higher, but you still want to give to charity. This would be a way to maybe do 5-10 years all at one time. So at least you get a deduction in at least 1 year. Otherwise, you're basically getting no benefit each and every year that you donate. So it's a great vehicle for those that want to get a tax deduction now and then donate later.
All right, let's do this. Let's kind of open it up for questions. I know we got about maybe 5 to 10 minutes left in this presentation. Let's just see what the people have for us.
Ray had a second question. He said, historically, if tax laws change mid-year, is the date the change becomes effective typically delayed until the following year, allowing investors to make the appropriate estimated taxes? Basically, would a 2021 tax change likely not be effective until 2022, allowing for additional Roth conversions and long-term capital gain harvesting in 2021 ahead of rising taxes?
So typically, and I will address back to 1980, because that's when I started my career. Typically, the ordinary income rates, when they change those go forward to next year, because it's not really fair to change them mid-year when people have done tax planning on an older rate. That's not to say they couldn't change, retroactively, but in the past, they've gone forward to the next year. Capital gain rates, on the other hand, is another animal. That usually changes on the enactment date, right? So let's say a bill passes in May 15th. May 15th, pre-May 15th, then you'd get the old rate. After May 15th, then you'd get the newer rate. The reason they can do that with capital gains is because the capital gain, when you sell an asset, you have a date. Your brokerage company gives you the date you sold that stock or mutual fund. Your rental property, what date from the escrow statement. So, and therefore, you would know after the bill was passed what the capital gains rate would be, which then would allow you to either do it or not based upon the tax law change. So that's typically how they've done it. California has had a tendency to try to make things retroactive, which has never been popular, but they have done that. The Fed's IRS has not.
And that's actually what David just pointed out. California tends to make the tax changes retroactive. Remember 2012.
That's exactly right. Yeah, they're a little more sneaky than the IRS.
Nancy says, do you have to take an RMD if you're still working at age 72?
No, that rule is still the same. So to avoid required minimum distributions, like your required beginning date is a better terminology. Your RBD is actually April 1st, the year after you retire, if you're over 72. So if you're still working and you're an active participant in a 401k plan, let's say at 75, you do not have to take a required distribution from that 401k plan. However, if you have other IRAs that are not part of that 401k plan that you're an active participant in, you would have to take a required distribution from any other retirement account. So the workaround is potentially roll those dollars into your 401k plan. That would reduce or eliminate the required distribution as long as you're an active participant in that plan. A couple other caveats is that if you own your own business and you have your own solo 401k plan, then that doesn't apply. So if you own more than, I believe, 10%.
Yeah, five.
I'm going off the cuff here. I don't know.
We're trying to be accurate.
You got all these notes in front of you.
I just got a couple. It's a blank sheet of paper. It's because it's all up here, brother.
You got it. So 5%. If you have 5%, then no.
All right. David says, for tax loss harvesting, Joe said that there could be a shadow purchase. Does that mean that the $10 stock is sold at $5, tax harvested, and then the same amount of the same stock is now purchased at $5?
Correct. It's exactly how that works. So if I have a stock at $10 a share, goes down to $5 a share, right? I sell Coke and buy Pepsi, right? Just something easy to think of, or Home Depot buy Lowe's, right? And then, so you're buying it, so you're reducing your basis. So if you sold 100% of that stock and bought 100% of the stock, there's really no benefit. But usually when you tax loss harvest, you're harvesting losses throughout, and you're not selling 100% of your assets, right? You're taking distributions from it. If you do not have any type of gain, or if you don't sell anything and have any type of gain, then you can write off $3,000 of that capital loss against ordinary income. Those other capital losses will continue to carry over until you utilize them all, so they carry over for life.
Okay, and at this point, we only have one more question, and it's not directly related to anything that we've talked about today. If you do have more questions, type them into the chat right now while we're dealing with this. And in the meantime, Susan has a question. I'm having a solar battery system installed. What do you know about the federal and state rebates?
Well, there's still the solar credit on the federal return. And that was 30%. I forget where we're at right now. That's being gradually phased out, so it's a slightly lower percentage. Do not have that in front of me, Joe, so I don't remember off the top of my head. However, as far as state doesn't really have any rebate, but they've historically had different programs where they allow you to either finance, and I'm not personally up on all that, but there may be some benefits on the state too.
All right, we want to thank you all.
One more quick question. Craig wants to know, what island is Al hiding on?
Yeah, I'm on Kauai, and for those of you that know Kauai, it's the Garden Isle, it's the Green Isle, but I'm in the South Shore, which is also called Poipu, which is the sunny side. It's the sunny side of the wet island, so it's perfectly sunny right now. In fact, as I sit here, I'm looking at the waves from my living room.
And our tax team just posted and said it's 26% for solar this year and 22% next year.
There you go. Good.
All right. Thank you very much. Okay. Hey, if you guys have additional questions, thoughts, concerns, you know where to find us. Again, thank you very much for your trust in us. We try to come out with new ideas, some different tax strategies and schemes that we can potentially help implement for all of you to reduce the overall tax burden. Company news, it's kind of the status quo. There's probably 6 or 7 of us that come into the office. Al is hibernating in Hawaii, so he moved his office to Hawaii, I guess maybe forever. And so, yeah, it's still kind of a shadow crew here. We're staying safe and social distancing and things like that, but we're all excited to get all of you, back into the office. So we miss you, and hopefully you and your family's doing great. So, any other questions, any thoughts? Give us a shout, give us a buzz. We'll probably have a few more webinars here towards the end of the year. Brian Perry might do something in regards to the overall markets. So watch our TV show, Your Money, Your Wealth. We're coming out with new content there as well. So Andi, thanks a lot for hosting this. This was great. Big Al, have fun in Hawaii, and we'll see you on the flip side, folks.
Thank you all.